Welcome back to Golden Rule Radio, your weekly precious metals update, and gold is doing just about exactly what we had been talking about last week. It bottomed right there at the 1204 marker, which is now the line in the sand, and it's right back up to 1250 and actually went to Miles's number of 1259 and topped right there.
So between 1204 and 1258, we should see a correction back down to about 1225. With a long-term correction possibly coming back down to that long-term trend line that we've been building over the last few months.
Which looks to be about 1180-ish?
Right at about 1180, 1172, I think, today. So by the time we get down there, we could see gold sub 1200 and it would still be aggressively bullish.
So what you're saying there is that we may or may not see that correction, but if we do, it would still be constructive with the base that we're building?
Exactly. What we're also noticing on the longer term chart, something we've also talked about in the past, are the weekly moving averages. Well, the long-term 65-week moving average, guess where it's at? 1258. And the 40-week moving average, guess where that's at? 1225, right where that price action is that I've got the line drawn on the chart. So I would expect price to stay between those two levels. If we do get a manipulative push below, we're going to hang above that long-term trend line.
I think it's also possible that we just don't even see this correction and it breaks above that 65-week moving average of 1258, which has been the resistance on this move, and it could just go right through that level and start to be bullish all the way into the seasonal pattern because we are heading into August right now.
Right, and that's exactly what we're seeing on the platinum chart, which we're going to look at here in a minute too. So, and that would certainly be exceptionally bullish to see gold just push right up coming into the Indian wedding season. Kids are getting back in school. People are starting to focus on investments again, and we absolutely could see gold just not even take that correction.
Silver, as usual, is following gold, and we're back above that compressing pennant line on the bottom part of the pennant, and you have your number here set at 1690. So essentially, if we get above 17 and start pushing up in that level, it's going to run.
Yeah, completely agree. I think silver is going to stay in this pennant, hopefully push above that 1690 again, like we just talked about, the seasonal strength in the metals coming up. And as soon as we see 1690 plus, I think we're on the move back up to 18, 19, maybe 20.
Gold-silver ratio is still in the mid-70s, so it does favor buying silver right now.
The big excitement this week for me, being a nerdy chart guy, is seeing the pennant breakout on the platinum side. Now, that did occur with divergence, so it does not surprise me to see a little bit of a slip back into that pennant range in platinum, but it's the first time we've seen a break above that pennant in a very long time.
So after that triple bottom, we've had strength and it's pushing back above or back into that pennant.
Not just into, but above.
Above.
So with that divergence, I wouldn't be surprised to see platinum correct back down somewhere between the 618 fib at 911 and this price action point line I've got on the chart at 908. And I think that's where your buy on platinum is. As Robert mentioned, the gold-silver ratio, we've also been arguing for the platinum-palladium ratio, and platinum is a screaming deal at these prices. So looking at that platinum-palladium ratio, the palladium side continues to consolidate and find a direction to go between levels. Need a push above 900 to argue up. I'd say a push below about 820 to argue down. So we'll just have to see how palladium plays out over the next couple weeks. But I think platinum is really the one to watch, and the direction platinum goes will help dictate where palladium goes. So Robert, what do you think about the dollar scraping the top of that channel we've had drawn on there for months?
Are you talking about the water slide?
I am talking about your water slide. So I definitely think this is where the dollar is going to get interesting. Are we going to see a rebound back up to some of the trend lines you've had drawn on the chart? Or are we just going to push right down to that 92 level and possibly sub 92 like I've been calling for? So what comes first?
I don't know, really. I've actually been doing a little experiment with the people I talk with, and whether they're clients or just people I meet and know, friends, whatever. And I asked them, do you think the dollar is up or down this year? And a lot of them don't know. They don't know if the dollar's up or down. The ones that do know that it's down, I then ask them, well, how much is it down? And if you look at the beginning of this year started at 103 with the dollar index. We're now at 94. That's about 9%. So throw out the fact that in a savings account, you're not even earning 1%, but then people in America who are just sitting with dollars, doing nothing with them, they've lost 9% just sitting in the dollar. They don't even know that.
We are going to have a Fed announcement this afternoon. So after we've recorded, and by the time you guys are watching this show, you'll already know what's happened. But we could see some dollar movement here this evening and tomorrow morning. I doubt it. I don't think they're going to say anything because they're very good at getting paid a lot of money to do nothing.
It seems like the central bank attitude around the world is now turning back to dovish.
Agreed. Last week we talked about Janet Yellen patting herself on the back for the job that they've done.
Felon.
So patting Janet Yellen on the back with one hand, he's also mentioned that Gary Cohn as a potential replacement coming this January, and said there are 2 or 3 others in the running. So sounds like we'll be trading in felon for con. Moving on to the Dow.
Or should you say moving up with the Dow, because the Dow's up again at a new all-time high today. We're going to look at a comparison that Miles mentioned last week of the Dow's performance versus the gold price's performance. And what do we have, Miles?
Sure. First, I do think short-term we could see 22,000 on the Dow. In fact, I'd almost expect it at this point. It would shift some of the fib levels up to some previous price action points. We have a massive gap down at 20,000 that never filled. So a move up to about 22,000 on the Dow puts a 50% correction on this last move right there.
And we've been saying to get out of the stock market for the last number of weeks, and we're just getting into more of a nosebleed section here. So do what you'd like, but we're going to eventually see the Dow exhausted.
Everybody's always looking for that spot to get out at the highest price possible. Hey, I rung the bell. Hey, pat me on the back. Well, we gave you where we think the Dow Transportation is last week at 10,000. This week, we're telling you we're thinking possibly around 22,000 for the Dow. I'd say the S&P at 2,500 and the NASDAQ at 6,000. So we've got a lot of double, triple, quadruple zero numbers coming up that line up with a bunch of technical indicators.
And that's all on a short-term basis, but we're going to look at a little bit more long-term basis here and look at the performance of what if you held gold versus shares of the Dow. What would your performance be over a long-term basis? Because a lot of you do that. A lot of you do sit in an asset and ride through volatility, ride it through number of decades. A lot of people they sit there in the stock market, in gold, or both.
2 weeks ago, I had a client of mine ask for some information put together for a presentation he was doing to his community, just looking at the comparison between gold and the Dow over the last 10, 20, 30, 40 years. So what I did is I took 2 time frames. I wanted to compare gold to the Dow since it became legal to own again. So early 1970s to today.
75.
And I wanted to compare gold to the Dow just this century, since really the start of the tech boom craze, 99, 2000.
And so you said earlier you were taking the lowest number in the 70s for the Dow. The lowest number being
$570 on the Dow, which followed the 45% drop in the Dow from 72 to 74. So we're looking at the $570 mark on the Dow, December 1974.
Which was the lowest in the 70s.
Correct.
Okay. So we're starting at the very bottom. If you bought the very bottom, we're going to do this experiment from that point.
Right. I'm not trying to fudge the numbers and pick some date where gold is really low and the Dow is high or vice versa. So the date I picked for gold was actually just prior to Nixon closing the gold window when it was fixed at $35 an ounce.
And that was 1971.
Correct.
And Nixon cut the tie with gold, said that other countries couldn't redeem their dollars in gold anymore. He stopped the exporting of our U.S. gold to other countries because they were saying, all right, if our dollar is as good as gold, then here are your dollars back. And we were having to ship gold to other countries. That's what he was talking. That's what Nixon did, was he cut that tie in 1971. Don McIlvaney then started our company in 1972, helped get some legislation moving in 74. Gold became legal in 75. So this is the time frame that we're looking at right there. $35 an ounce, 1971. Go, Miles.
Yeah, and that was the era where we had a massive transition from physical real assets to OPEC, fiat currencies, and Federal Reserve control over those fiat currencies and other things as well. So let's take the lowest price possible in the Dow in the 1970s, December 74, $570 compared to today.
At 21,700 today.
So you're looking at roughly a 38-fold increase in the Dow. Compare that to gold. 1971, as Robert mentioned, $35 an ounce to today. You're looking at a 35-fold increase. So right off the cuff, the first thing that you hear is, well, the Dow is doing slightly better than gold.
But that's from the absolute bottom had you bought the day that it hit 570 to the top today and held on.
Right now today.
Right.
So let's be fair here. Since we took the absolute bottom to give the Dow the benefit of the doubt, lowest price possible, let's take the absolute top in both now. So instead of comparing to today's price, if you look at $35 gold to the top in the gold market,
1900-ish,
just over 1900, you're actually looking at about a 54-fold increase in gold compared to the bottom in the Dow market to the absolute top in the Dow, again, 38-fold.
So that's a long-term basis from the 70s till now. And let's look at a more shortened time frame, like 20 years, 15, 17, 20 years. What do you want?
How about 17 years?
Okay, turn of the century.
Actually 18 years since it's 2017.
Oh, turn of the millennium.
Turn of the millennium. Again, if you look at the bottom in the gold market, late 1999 of $252.50 to the market high of around 1920, that's a 7.6-fold increase. You look at the Dow, market bottom 2002, 79.01, to the current high, that's a 2.7-fold increase. And then you say, okay, Miles, well, that's great, but the high in gold was years ago. Well, let's compare just to today. Just to today, a 2.7-fold increase in the Dow. And gold, having been down for a number of years now, is still beating the Dow up almost 5-fold.
So again, that is from the absolute bottom to the absolute top is the first one that you compared. And then just what you mentioned there, almost 5-fold, is from the absolute bottom to today's price of gold at $1,250.
And the Dow's price at over 21,000.
Right, which is an all-time high. So obviously nobody is going to time the very, very bottom of these markets. We know that. We get that.
But the point here is you don't have to.
Exactly.
Over a long enough timeline, investments that are meant to be speculative investments should be treated as speculative investments. And investments like precious metals, investments like real estate, those are your long-term holds. And thanks to the decisions that Nixon made, that Greenspan ran with, that Janet Yellen now controls, and the inflation of the US dollar over the last 40 years, fixed assets have and will continue to drastically outperform their paper counterparts.
Going forward from here, I think that trend will continue. I think gold will outperform the Dow significantly in the next 3 to 5 years.
Well, and one last fun little comparison to the 1970s. In the 1970s, we went from 35 an ounce to 190, 190 down to about 102, 105, and then 102, 105 to 850.
Right.
Add a zero to that.
Right.
In the 2000s, we started at around 350 and went up to 1900. 1900 back down to about 1050.
Right.
Now, I'm not saying gold's going to 8,500.
You might be.
But I might be.
Thanks for listening to us this week, and click the subscribe button below this video to stay up to date with us.
And you can follow us on Twitter at ICA Gold. As always, can give us a call if you have questions, 800-525-9556, or post questions in the comments.
Have a good week.